The early weeks of March 2025 painted a picture of cautious optimism. The Swiss economy, known for its resilience, was showing signs of a promising future. Business leaders and financial experts were closely monitoring various indicators. The bustling financial district of Zurich was a testament to the country's economic vitality. Professionals in business attire moved with purpose, reflecting the dynamic nature of the Swiss economy. Chief financial officers were looking towards the future with confidence. Meetings were filled with discussions about growth strategies and investment opportunities. Data from Deloitte's CFO Survey indicated a fairly upbeat mood. Many CFOs were optimistic about their company's prospects. A significant majority anticipated positive developments for the Swiss economy in the coming 12 months. Switzerland's robust financial sector, high-value manufacturing and strong export orientation contributed to this confidence. The global economic environment had not yet presented an immediate threat to the Swiss model. Switzerland's economic policies had insulated it from many global shocks. The relative economic tranquility in Switzerland during March 2025 was abruptly shattered on April 2nd. The Swiss economy, known for its stability and resilience, was suddenly thrown into a state of uncertainty. The Trump administration announced sweeping new tariffs termed Liberation Day tariffs. These tariffs were part of a broader strategy to address trade imbalances and protect American industries. Products imported from Switzerland into the U.S. would face tariffs of 32%. This significant increase in tariffs was expected to have a profound impact on the cost of Swiss goods in the American market. This announcement sent immediate shockwaves through the Swiss business community. Executives and business leaders were left scrambling to understand the implications and to formulate a response. The U.S. has been Switzerland's most important single-country export market since 2021. The new tariffs threaten to disrupt this crucial trade relationship, potentially leading to a decline in Swiss exports. The rationale behind the high tariffs on Swiss goods was unclear, adding uncertainty. Business leaders were left in the dark about the future of their trade with the U.S., leading to a climate of confusion and concern. Swiss industries faced the prospect of their products becoming significantly more expensive in their largest export market. This price increase could lead to a decrease in demand for Swiss goods, further impacting the Swiss economy. Deloitte conducted a second survey between April 7th and April 14th to gauge the immediate reaction of Swiss CFOs. The survey revealed widespread concern and uncertainty among Swiss business leaders. The Liberation Day tariffs were a geopolitical event with significant implications. They not only affected trade relations between the U.S. and Switzerland but also had the potential to influence global trade dynamics and economic policies. The second wave of Deloitte's CFO survey in April painted a stark picture of collapsing confidence. Switzerland's economic prospects experienced an 84 percentage point fall between March and April. Only 15% of CFOs anticipated positive economic developments for Switzerland in the coming year. Conversely, 58% expected negative or highly negative developments. The pessimism extended to their own company's financial prospects. In April, only 23% of CFOs rated their company's prospects as positive. The percentage anticipating negative developments surged to 43%. The U.S. tariffs were perceived as a potential roadblock to growth and profitability. The anxiety among Swiss CFOs was deeply intertwined with a souring view of prospects for key trading partners. The U.S. tariff announcement accelerated pessimism about the economic health of major global players. 89% of Swiss CFOs expected the U.S. economy to take a significant downturn. 81% anticipated negative economic developments in Germany. 64% forecasted negative developments for the Chinese economy. The confluence of negative expectations for the US, Germany, and China created a deeply unsettling picture for Swiss businesses. The optimism of late 2024 had given way to a much more cautious assessment of the international landscape. The sharp decline in macroeconomic optimism translated into a more cautious view of companies' futures. Forecasts for sales revenue began to nosedive. Profit margins came under intense pressure. Companies faced the choice of absorbing tariff costs or passing them on to U.S. consumers. Investment plans were re-evaluated and often shelved. The Deloitte survey revealed that Swiss businesses hadn't exhibited such caution since the COVID-19 pandemic. Forecasts for headcount were also declining. Companies tightened their belts, reflecting a clear understanding of the changed operating environment. Amidst the pessimism, one market stood out as a beacon of hope: India. A majority of Swiss financial leaders expected business conditions in India to improve. India has been experiencing robust economic growth. The signing of a free trade agreement between Switzerland and India was a significant factor. This agreement would reduce trade barriers and facilitate easier access for Swiss goods and services. The positive sentiment indicated a growing recognition of India's importance. Cultivating stronger economic ties with India is a strategic imperative for Switzerland. Faced with hefty U.S. tariffs, Swiss CFOs were not passively awaiting their fate. 72% indicated a desire to take preparatory action against the negative impacts. One primary strategy was increased investment in technology. Another significant area of focus was cost-cutting in other operational areas. Companies were also considering direct responses to the tariff impositions. Adjusting selling prices and shifting operations to other countries were on the table. These decisions indicated a willingness to fundamentally restructure operations if necessary. The U.S. tariffs spurred immediate action at the highest levels of the Swiss government. Swiss President Karen Keller-Sutter engaged in a direct phone call with U.S. President Donald Trump. She emphasized the significant role that Swiss companies play within the U.S. The Trump administration announced a 90-day pause on the tariffs. Swiss Foreign Minister Ignazio Cassis suggested a coalition of affected countries. Swiss pharmaceuticals giant Roche announced plans to invest $50 billion in the U.S. This investment was interpreted as a strategic gesture to foster a favorable trade environment. The 90-day pause on the U.S. tariffs provided Switzerland with a critical breathing space. This temporary relief allowed Swiss businesses to reassess their strategies and prepare for potential future challenges. The Swiss government, along with key industry leaders, convened multiple meetings to discuss the implications and possible responses to the ongoing trade tensions. The core issue of potentially crippling tariffs remained unresolved. Despite the temporary pause, the looming threat of increased tariffs created an atmosphere of uncertainty. Businesses were particularly concerned about the long-term impact on their supply chains and profit margins. Michael Gramp, a prominent economist, warned that without a satisfactory agreement, Switzerland might face a recession. His analysis highlighted the interconnectedness of global markets and the vulnerability of the Swiss economy to external shocks. The sharp deterioration in CFO sentiment underscored the immediate challenges. Financial leaders were increasingly pessimistic about the economic outlook, citing declining consumer confidence and reduced investment as major concerns. Adaptation became the watchword, with companies exploring cost-cutting and technological upgrades. Many businesses began investing in automation and other advanced technologies to enhance efficiency and reduce dependency on volatile international markets. The exploration of diversified export markets, with India emerging as a promising avenue, was crucial. By tapping into new markets, Swiss companies aimed to mitigate the risks associated with over-reliance on traditional trading partners. The willingness of 72% of CFOs to take preparatory actions demonstrated a commitment to finding solutions. This proactive approach included measures such as diversifying supply chains, seeking new investment opportunities, and enhancing risk management practices. The substantial investment pledged by Roche signaled a form of strategic engagement. This move not only aimed to bolster the company's future growth, but also served as a vote of confidence in the resilience and adaptability of the Swiss economy.